Have you ever wondered what cryptocurrency really is? You've probably heard about Bitcoin, seen headlines about people making fortunes, or heard stories about digital money that exists only online. But what exactly is cryptocurrency, and how does it actually work? Before we dive in, make sure to subscribe to the channel and hit that notification bell. We are releasing new guides every week to help you stay ahead of the market, and you don't want to miss out. In today's digital age, cryptocurrency has become one of the most talked about financial innovations of our time. It's reshaping how we think about money, transactions, and the entire financial system. Whether you're completely new to this topic or you've been curious about diving deeper, this video will break down everything you need to know about cryptocurrency in a clear, straightforward way. We'll explore what cryptocurrency actually is, dive into the fascinating technology that makes it possible, discuss whether it's a good investment, learn the essential terms you need to know, and weigh up the real advantages and disadvantages of this revolutionary technology. By the end of this video, you'll have a solid understanding of cryptocurrency and be able to make informed decisions about whether it's something you want to explore further. So let's dive in and demystify the world of cryptocurrency together. Let's start with the basics. Cryptocurrency is a digital or virtual form of money that uses cryptography for security. Unlike traditional currencies like dollars or euros, cryptocurrency exists only in digital form. There are no physical coins or bills you can hold in your hand. The term crypto comes from the cryptographic techniques used to secure transactions and control the creation of new units. What makes cryptocurrency truly unique is that it operates on a decentralized network. This means there's no central bank, no government, and no single authority controlling it. Instead, cryptocurrency relies on a technology called blockchain, which we'll discuss in detail shortly, to maintain a transparent and secure record of all transactions. The concept of digital currency isn't entirely new. Attempts at creating digital money date back to the 1980s and 1990s, with projects like DigiCash and e-gold. However, these early attempts failed because they still relied on centralized systems, which made them vulnerable to fraud and government intervention. The breakthrough came in 2008 during the global financial crisis. An anonymous person or group using the pseudonym Satoshi Nakamoto published a groundbreaking paper titled Bitcoin, a peer-to-peer electronic cash. This paper outlined a revolutionary idea, a completely decentralized digital currency that would allow people to send money directly to each other without needing banks or other intermediaries. In January 2009, Nakamoto mined the first Bitcoin block, known as the Genesis block, and the cryptocurrency era officially began. The first real-world Bitcoin transaction happened in May 2010, when a programmer named Laszlo Hanyecz famously paid 10,000 Bitcoins for 2 pizzas. At today's prices, those pizzas would be worth hundreds of millions of dollars, making them arguably the most expensive pizzas in history. Bitcoin's success inspired thousands of other cryptocurrencies. Ethereum, launched in 2015 by Vitalik Buterin, introduced smart contracts and expanded what blockchain technology could do beyond just transferring money. Today, there are over 20,000 different cryptocurrencies, each with unique features and purposes. Some focus on privacy, others on speed, and some aim to solve specific problems in various industries. The fundamental idea behind cryptocurrency is financial freedom and democratization. It gives people control over their own money without needing permission from banks or governments. This is especially important in countries with unstable currencies or restrictive financial systems, where cryptocurrency can provide access to the global economy.
How does a cryptocurrency work? Now that we understand what cryptocurrency is, let's explore how it actually works. The magic behind cryptocurrency lies in a technology called blockchain, which is essentially a digital ledger that records all transactions. Imagine a notebook where every transaction is written down. Now imagine that this notebook is copied and distributed to thousands of computers around the world. Every time someone makes a transaction, all these computers update their copies of the notebook. This is basically how blockchain works. It's a chain of blocks where each block contains a list of transactions. Here's how a transaction happens. When you want to send cryptocurrency to someone, you initiate a transaction through your digital wallet. This transaction is broadcast to the entire network of computers called nodes that maintain the blockchain. These nodes verify that you actually have the cryptocurrency you're trying to send and that you haven't already spent it elsewhere. Once verified, your transaction is grouped together with other transactions into a block. Before this block can be added to the blockchain, it needs to be validated through a process called mining. This is where things get really interesting. Mining is the process by which new transactions are verified and added to the blockchain, and it's also how new cryptocurrency is created. Miners are essentially powerful computers that compete to solve complex mathematical puzzles. The first miner to solve the puzzle gets to add the new block to the blockchain and receives a reward in the form of newly created cryptocurrency plus transaction fees. These mathematical puzzles are intentionally difficult and require enormous computational power to solve, but once solved, the answer is easy for other computers to verify. This system, called proof of work, ensures that no single entity can easily manipulate the blockchain. To change even one transaction in the past, you'd need to redo all the work for that block and every block that came after it, which is practically impossible. The security of blockchain comes from this combination of cryptography and distributed consensus. Each block contains a cryptographic hash, which is like a unique fingerprint. This hash is created based on the transactions in the block and the hash of the previous block. If someone tries to alter a past transaction, it would change the hash of that block and break the chain, making the tampering immediately obvious. Not all cryptocurrencies use mining. Some use alternative methods, like proof of stake, where validators are chosen to create new blocks based on how many coins they hold and are willing to stake as collateral. This method uses far less energy than mining and is becoming increasingly popular. The blockchain's transparency is another crucial feature. Anyone can view the entire history of transactions on a public blockchain, though the identities behind the transactions are protected by cryptographic addresses. This transparency builds trust in the system while maintaining user privacy.
One of the biggest reasons people get interested in cryptocurrency is its potential as an investment. Let's explore what this means and what you need to know if you're considering investing in cryptocurrency. Cryptocurrency has become an asset class that many investors add to their portfolios alongside stocks, bonds, and real estate. The investment appeal comes from several factors, primarily the potential for significant returns. Bitcoin, for example, has delivered returns that far exceed traditional investments over the past decade, though with considerably more volatility. When you invest in cryptocurrency, you're essentially buying digital tokens that you believe will increase in value over time. The value of these tokens is determined by supply and demand in the market. If more people want to buy a particular cryptocurrency than sell it, the price goes up. If more people want to sell than buy, the price goes down. There are different approaches to cryptocurrency investment. Some people are traders who buy and sell frequently, trying to profit from short-term price movements. Others are long-term holders, often called hodlers in crypto culture, who believe in the long-term potential of cryptocurrency and hold their investments through ups and downs. There's also staking, where you lock up your cryptocurrency to help secure a network and earn rewards, similar to earning interest. The cryptocurrency market operates 24 hours a day, 7 days a week, unlike traditional stock markets. This means prices can change dramatically at any time, and you need to be prepared for significant volatility. It's not uncommon for cryptocurrencies to gain or lose 10 to 20% of their value in a single day. Diversification is important in cryptocurrency investment, just as it is in traditional investing. Rather than putting all your money into one cryptocurrency, spreading your investment across different projects can help manage risk. Some investors focus on established cryptocurrencies, like Bitcoin and Ethereum, while others seek out newer projects with higher risk but potentially higher rewards. Before investing, it's crucial to do your research, known as due diligence in the investment world. Look into the team behind a cryptocurrency project, its use case, its technology, and its community. Understand what problem it's trying to solve and whether it has a realistic chance of success. It's also essential to only invest money you can afford to lose. Cryptocurrency is highly speculative, and while some people have made substantial profits, others have lost significant amounts. Never invest borrowed money or funds you need for essential expenses. Tax implications are another important consideration. In most countries, cryptocurrency investments are subject to capital gains taxes. This means you may owe taxes when you sell cryptocurrency for a profit. Keep detailed records of your transactions for tax purposes. Remember that past performance doesn't guarantee future results. Just because a cryptocurrency has performed well in the past doesn't mean it will continue to do so. The market is influenced by numerous factors, including technological developments, regulatory changes, market sentiment, and broader economic conditions. To understand the current landscape, it is essential to look at the milestones that brought us here. The story begins long before Bitcoin with the concept of digital cash. In the 1980s and 90s, cryptographers and cypherpunks like David Chaum attempted to create anonymous electronic money.
While these early projects failed due to centralization issues, they laid the cryptographic foundation for what was to come. The true birth of the industry occurred in 2008 with the publication of the Bitcoin White Paper. An anonymous creator known as Satoshi Nakamoto introduced a solution to the double spend problem without relying on banks. In January 2009, the first block, known as the Genesis block, was mined, officially launching the Bitcoin network. The era of altcoins began around 2011 with the emergence of Litecoin and Namecoin. Developers realized that Bitcoin's code could be modified to create coins with different properties, such as faster transaction speeds or improved privacy features. The launch of Ethereum in 2015 marked a second major turning point. Vitalik Buterin introduced a blockchain that was programmable. This ushered in the age of smart contracts, allowing developers to build not just new coins, but entire decentralized applications, or dApps, vastly expanding the utility of the technology. The ICO, initial coin offering boom of 2017, demonstrated the power of global crowdfunding. Thousands of startups raised billions by issuing their own tokens. Despite many scams and a subsequent market crash, this period brought a massive influx of new users and capital into the ecosystem. The future of crypto is being shaped right now, shifting from speculative trading to practical utility and infrastructure. The primary goal for the coming years is mass adoption. It is expected that cryptocurrency technology will become an invisible backend for everyday apps. Users will transfer value or pay for services without even realizing they are using blockchain, as user interfaces become seamless and intuitive. CBDCs, or central bank digital currencies, are set to transform the global financial system. These are government-issued versions of national currencies, like a digital dollar or euro. Unlike decentralized crypto, they are fully controlled by the state, which may lead to the phasing out of physical cash and increased financial surveillance. The evolution of Web3 promises a new iteration of the Internet where users truly own their content. Currently, data lives on corporate servers. In the future, your identity and digital assets will be managed through your crypto wallet, giving you sovereignty over your online presence. Regulation will become stricter, but will provide much-needed clarity. Governments are establishing frameworks like MiCA in Europe to police exchanges and stablecoins. While this may reduce anonymity, it paves the way for institutional investors, pension funds, and banks to enter the market safely. Issues with speed and cost will be solved by Layer 2 solutions. Networks built on top of major blockchains, such as the Lightning Network for Bitcoin or Arbitrum for Ethereum, will process thousands of transactions per second for fractions of a cent, making microtransactions economically viable. Finally, the tokenization of real-world assets, RWA, will bridge the digital and physical worlds. Real estate, stocks, gold, and art will be represented as tokens on the blockchain. This allows for fractional ownership, meaning you could buy 1/100th of a rental property instantly using your smartphone.
To navigate the crypto landscape confidently, you must master the specialized vocabulary that defines it. The foundation of everything is the blockchain, a decentralized digital ledger that records all transactions across a network of computers. Unlike a bank's private database, a blockchain is transparent and immutable, meaning once data is written, it cannot be altered or deleted. Mining, or staking, depending on the network, is the process by which new coins are entered into circulation and transactions are confirmed. Computers solve complex mathematical problems to secure the network, and in return, they are rewarded with cryptocurrency. A seed phrase, or recovery phrase, is arguably the most critical security term you will learn. It is a generated list of 12 to 24 random words that acts as a master key for your wallet. If you lose your device or password, this phrase is the only way to recover your funds. If you lose it, your money is gone forever. Stablecoins are cryptocurrencies designed to minimize volatility by pegging their value to a stable asset, usually a fiat currency like the US dollar, example USDT or USDC. They allow traders to keep value on the blockchain without being exposed to the wild price swings of assets like Bitcoin. Whales are individuals or entities that hold massive amounts of cryptocurrency. Because they own such a large percentage of the supply, their buying or selling actions can significantly impact market prices, often causing sudden ripples in the market. HODL is a popular slang term that originated from a typo of hold in an early Bitcoin forum. It now stands for hold on for dear life, representing a strategy where investors refuse to sell their crypto despite short-term market volatility or crashing prices. ATH, or all-time high, and ATL, all-time low, refer to the highest and lowest price points a cryptocurrency has ever reached in its history. These metrics are frequently used by analysts to gauge potential growth or assess market cycles.
Proper storage is the first line of defense in protecting your digital wealth. Unlike traditional banking, there is no customer support to reverse a mistake. It is a common misconception that wallets store your coins. In reality, they store your private keys. Your coins always live on the blockchain, but your private key is the digital signature required to authorize a transaction. Think of it like a password that gives you, and only you, the right to move your funds. Hot wallets are software applications connected to the internet, available as mobile apps or browser extensions like MetaMask. They are incredibly convenient for daily trading and connecting to decentralized applications or DApps. However, because they are always online, they are more vulnerable to hacks and malware. Cold wallets or hardware wallets are physical devices, often resembling USB drives, that keep your keys completely offline. Brands like Ledger or Trezor are industry standards. Since they are not connected to the internet, they are immune to remote hacking attempts, making them the gold standard for long-term storage. Custodial wallets are those provided by centralized exchanges. When you leave money on an exchange, you do not actually own the private keys. The exchange manages them for you. This carries the risk famously summarized by the phrase, "Not your keys, not your coins." If the exchange goes bankrupt, you could lose everything. Non-custodial wallets give you full control. You are the sole custodian of your private keys and seed phrase. While this offers maximum freedom and security from third-party failures, it also means you bear total responsibility for safeguarding your backup information. Air-gapped computers or devices take security a step further by ensuring the device holding the keys never physically connects to a network. Wi-Fi and Bluetooth are disabled. This method is used by institutional investors or individuals storing life-changing amounts of wealth to ensure absolute isolation from online threats. I hope this breakdown helps you feel more confident navigating the complex world of digital assets. If you found value in this content, please hit the like button. It really helps support the channel and ensures this information reaches others who need it. Don't forget to subscribe and ring the notification bell so you never miss an update. We have plenty more to cover, from mastering trading strategies to deep diving into new projects. Most importantly, we want to hear from you. Drop a comment below. Which part of cryptocurrency do you find the most confusing? Or what specific topic would you like us to cover next? We read your feedback to build content that actually helps you. Thanks for joining us, and I'll see you in the next one.